Hey, thanks for coming and watching this video. I'm going to share with you one of my favorite Emini trading strategies today. And by the way, I'm doing this on the E-minis because I like to trade the E-minis, but this will also work for stocks and forex, commodities, because I trade those markets as well, and I use the same principle when I trade those markets. So this is really for anybody who is doing technical analysis. So the bottom line that we're going to look at today is using multiple time frames. Now, using multiple time frames is a very common technique used in technical analysis, and what I mean by that, just to be very clear, is over here we have a 5-minute chart, and then we would compare that on the chart to the right, which is a 15-minute chart. Now, don't get caught up in the time frames. I normally don't even trade a 5-minute chart too much. In intraday, I like to trade like a 2-minute chart or tick charts. But for swing trading and for trading options, I'll also use daily charts, weekly charts. For investing, I use monthly. So you can do this with various fractals or scale. And by that, I mean various time intervals. So we're looking at different markets and different time frames. So here's the key. I like to use a 3-to-1 ratio. So if this is my setup chart, the 5-minute chart, then my longer term time frame is going to be 3 times that, which is a 15-minute chart. And I call this chart on the right the energy of scale, or the fractal energy. So energy of scale is probably a little more accurate than fractal energy, but you can call it whatever you want as long as you understand the idea. We're looking at the same market, but on a different scale, different time interval. Okay, now, this is a traditional approach using multiple time frames. However, there is a problem with the traditional approach, in my opinion. And that approach, by the way, is going to be a little controversial here because you're going to hear things different from other people, and that's okay. But here's my opinion. Here's how I look at it. So the traditional orthodox approach is to say only take a trade on your setup chart, the shorter term chart on the left, if it's in the direction of trend of the longer term time frame. That's the traditional orthodox approach. In my opinion, that is not optimal. And the reason for that is, well, twofold. It was never optimal, even though in the old days we used to be able to get away with that. I've been trading for 49 years, so I remember those days, and a lot of the classic technical analysis books would tell you this. But you could get away with it back then because you didn't have things like massive retail traders with direct access and low commissions getting in and out, in and out, in and out. And in those days, we also didn't have high-frequency trading, logarithmic trading, things that where computers are just in a split second placing orders and canceling orders, covering orders, things like that. So the result of all these new things is that markets are choppier now, and trends generally don't follow through as much as they used to. So that's one reason that this technique doesn't work very well anymore. Now, as I said, the technique was never really optimal, and the reason for that is because trend. Trend is defined, if you look it up in Webster's dictionary, it's defined to extend in a general direction. So the operative words there being extend and general, therefore meaning a long-term move. And that's what makes trend trading so great, is that because trend, by definition, is a long-term move, if we get early into a new trend, we can get a very good reward-to-risk ratio, which is what we're always looking to get, of course. So trend trading is great, but one of the downsides is that trend is always a lagging indication, always, by definition. And I don't care what indicator you use or whatever, it's going to be lagging. So that's a bit of a problem. So where it becomes a problem with this old style of, this old technique of using multiple time frames is you're then saying, well, I'm going to confirm my trade on the short-term chart with a lagging indicator on an already 3 times slower chart. Therefore, the 2 time frames are not synchronized very tightly, and that causes a problem for timing your entries. So to overcome that, what we do is now we use a faster indicator on the longer term chart. And I like to use momentum. momentum. And that's my momentum indicator down here. It's actually the line that turns green and red. So here is my trend indicator. And by the way, this, you can use all kinds of different indicators. I'm not going to get into specific indicators today. So this is my trend indicator. As you can see, it's down here, but momentum is up. So they're contradicting each other. And you can see price is moving up dramatically. But this is not necessarily, the long-term move, and that's why the trend is angling down. But momentum responds much more quickly. So in today's choppy markets, that is actually very, very helpful. So if we go over here, and let me bring up my global crosshairs now so we can see where our charts align. So here's one of my trade setups, and you can actually even take it right there. That being a little aggressive, that's a very conservative setup there. And this, I'll just tell you, it's called the X marks the spot trade. And basically we have the red line angling down, the black line angling up. Those are the 50 SMA and the 15 EMAs. The red line is the simple moving average, 50 simple moving average. The black line is the 15 exponential moving average. And the setup is very simple. There's a little more to it, but the basic structure is this, where we have 50 MA angling down, 15 crossing it, and price gets above the 50. It retraces right into that cross, right into that X. So X marks the spot. Now, we need also a couple of other things. We need our cycle low to say it's time for that market to stop going down. And here's the momentum indicator, and it stays above 0. So therefore, it's also saying, see, here's your 0 line, that momentum is strong to the upside. So we need all of that. And then finally, we also need confirmation from the higher time frame. So when we use our global crosshairs, there we go. You can see that on the longer-term chart, the 15-minute chart, where the vertical line is, that is showing us that, yes, the momentum indicator down at the very bottom, the green line coming up, that is angling up. However, you'll notice that the red line above price is angling down, which is our trend indicator. So this gives us a faster, accurate, more timely signal to confirm our trade entries. If I was using trend, if I used the old traditional technique and said, no, I can only trade in the direction of trend of the longer-term time frame, I'd be kept out of a very, very profitable trade here. So that's the principle, and it works very, very well. Again, as markets change and things change, technology changes, we need to adapt and be flexible, and this is something that, believe me, will save you a lot of money. First of all, it'll get you into more opportunities than you would otherwise be kept out of, but by using the, I call it really a confirming indicator. I won't take the trade unless it's confirmed by momentum on the next higher time frame. And believe me, by doing that, that saves me a lot of money. Otherwise, good-looking setups will be filtered out by making sure that momentum is on my side on the next higher time frame. So that's it for today. If you like the video and you're watching this on YouTube, please click the thumbs up icon below and leave a comment telling me what you'd like me to cover in future videos or what you liked about this one. Also, I'm giving away one of my favorite trade strategies. I call it the rubber band trade. You can get it absolutely free. It has a really high win-loss ratio. It's a simple strategy. You can learn in about 26 short minutes. So get that video explaining that trade strategy by clicking on the image in the top left corner. Or if you're on a mobile device, click on the little eye with the circle around it in the top right corner of this video. And once you do that, I'll personally email the first video to you absolutely free.